This is Chapter 1 for EC 342, Financial Markets and Money. So in Chapter 1, we just have a brief overview of what the course is going to cover, what the textbook covers throughout the semester. So why would we want to study financial markets? The main reason that we want to study financial markets is because that's how we transfer money from one person to another. We use money to buy goods. We get money from our employer that transitions through a bank account of some sort. We use the money in our bank account to pay for goods. So we want a good understanding of why financial markets work the way they do. We also invest money. We might buy stocks. We might invest it in other things. We want money for the future. We might buy property. So financial markets are important for a variety of reasons. We also might be interested in working in the financial markets. The first market we talk about is the bond market. So a bond is a security that promises to make payments over a specific period of time. There are multiple different kinds of bonds. Bonds carry a carrying value and have an interest rate. Interest rate is the cost of borrowing. High interest rate means that we have less buying power and vice versa. The most common bonds are government bonds. So the government has a lot of different types of, we have US government long-term bonds, there are US savings bonds, 3-month treasury bills. We also have corporate bonds. Corporations can sell bonds on the market. Not mentioned here are municipal bonds, and that is when city governments sell bonds for specific projects. When we get further into different chapters, we're going to look at the bond and the bond market more specifically. What this chart shows us is how the interest rate has fluctuated on specific bonds from 1950 to 2017. As we can see in the 80s, we had higher interest rates than any of the other years. And 3-month treasury bills have suffered the most in recent years for the amount of interest available on them. A second market that we talk about in this class is the stock market. So in the United States, the stock market is the New York Stock Exchange, where we sell shares of stock in corporations. Each share is a percentage ownership in that company. The Dow Jones average of the stock market, as we can see from this graph, shows what the stock market average from 1950 to 2017 was. We can see some pretty significant dips in the New York stock market. Here, we have this dip here right around 2000. This is from the tech dip. So when Silicon Valley dipped, the internet bubble burst. That's what this one here is. Over here, we have the drop from the 2008 financial crisis. We see different ups and downs throughout various years. We will see a lot of fluctuations in 2017 to 2025 when this graph is updated, as we've had some pretty volatile market periods. As we know, at the beginning of the pandemic, the Dow Jones dropped, it's recovered, but there are a lot of things that have changed the way that the Dow Jones has moved over the last couple of years. Financial intermediaries. So these are our financial institutions. The most common of these financial institutions is banks. Most of us have used a bank before. We go to a bank to deposit our paycheck, we take money out, we might have a loan for a car or a mortgage or a variety of things. We have other financial institutions. So we have finance companies, investment companies, we have companies that manage pension funds and mutual investment funds. Insurance companies can also be financial institutions, depending on the insurance company and what it does. For an example, some whole life insurance is a financial investment. What that means is various whole life insurance companies pay dividends, allow cash loans on the cash value of the insurance, low interest loans, and so they're financial management tools for their customers. So that's one of the examples in how an insurance company becomes a financial institution. We also talk about financial innovation in this class. This is the development of new financial products and services. As technology has grown, we've changed a lot of the ways that we do banking and interact with our finances. In class today, we talked about a couple of different financial innovations. So we talked about how interacting with our money has changed just in the last couple of years. And some of the examples that we brought up were our ability to pay with our cell phone or our watch, that Facebook has a pay function now that's available online. We can use PayPal. We can do e-billing or e-payments where we pay through our bank instead of writing physical checks or going to the bank and drawing cash out to go to the grocery store. So our ability to deliver financial services electronically has grown over the years. We also talked a little bit about the introduction of cryptocurrencies and the blockchain technology that drives those cryptocurrencies. We're going to talk more about cryptocurrency and blockchain in future chapters. We also talked about financial crises. So why would we study financial crises as part of financial institution and banking? Well, we have major disruptions in our financial market. We can have major disruptions in the stock market. We can have major disruptions in how money fluctuates and flows based on a variety of things. So one of the things that we talked about was the 2008 financial crisis. So in the 2008 financial crisis, we saw a sharp decline in the value of houses and a sharp decline in the stock market. We also talked about how many retirement accounts are invested in the stock market and mutual funds. So people who were planning to retire in 2009, 2010, 2011, 2012 that lost a large part of their financial savings if it was invested in the stock market from that dip and haven't fully recovered might be inclined not to retire. So when people don't retire out of the workplace, that can affect the number of jobs that are available for new people coming into the workplace. This affects unemployment rates and people's abilities to get jobs in certain industries. So there are a lot of ways that financial crises can greatly impact economies and financial institutions. Monetary policy is the rules and regulations and the different policies that we have around our financial markets, our financial institutions, how we look at financial crises. So we talked some about recessions and unemployment. We talked some about 2008 and that recession and unemployment. We also talked a little bit about how the pandemic has altered some of how we're looking at finances and monetary policy. One of the policy things financially we talked about was the stimulus check that Congress did earlier. So they had that COVID stimulus package. Another monetary policy are tax laws and how that affects the amount of take-home income we have to pay for goods, and how we generate business cycles based on our purchases in the economy. We talked about price level inflation and how the level of average price of goods and services in the economy can change for a variety of reasons. Inflation is one of those reasons. So we talked about in the case of the last couple of months in the pandemic, we talked about how the price of groceries have gone up in the last couple of months, and that there's a supply and demand issue in the last couple of months. I asked students in the class to think about products that they've gone to shop for in the last couple of months that they haven't been able to purchase because stores have been out, not sure about when they're going to be resupplied. This can affect the average price of goods and services. Because if you've taken other economics class, you'll know that as demand rises, the price can also rise for those goods. This graph shows how the money growth rate has changed over a variety of years in the United States and the business cycle in the United States. This graph looks more at the aggregate price level. So how have our prices changed in relation to our money supply? So as we can see, until about 2008, they've been pretty steady together. So the aggregate price level higher than the actual supply of money. In 2008, they cross, and that changes. So the price level is still going up, but our money supply changed in 2008. We also talked about inflation. So this figure shows the average inflation rate versus average rate of money growth for selected countries over a 10-year period. Now in class today, we talked about one of the countries that is missing off this chart, and that is Venezuela. So if you haven't read any news about Venezuela, Venezuela is suffering right now from an extremely high rate of inflation. Their inflation rate is so high that their money has no value. And they're having a lot of economic strife because of that. Interest rates are tied directly to money and money policy. So before 1980, the amount of money growth and interest rates was closely correlated to the long-term treasury bond rates. Since then, that is not as clear of a relationship. Interest rates are generally driven by a variety of things. So we have monetary policy, we have any financial crises that have been happening, the federal bank set interest rates based on current policies, current money supply, the current price of money, and if we've had financial crises or stuff. One of the things we do know is that the trend for interest rates is a downward trend. Interest rates have been getting lower and lower over the most recent years. This figure shows the interest rates versus the amount of money growth in the United States. We have a peak in the 80s, and then interest rates decline. We know in the last couple of years that interest rates have been historically low. Now, are low interest rates a good thing or a bad thing? It really depends on what you're doing. If I'm investing money, low interest rates is a bad thing. That means I'm not going to make as much money on that investment. However, if I'm taking out a mortgage or a car loan, a low interest rate is a benefit because that means that I'm not going to pay as much for the use of that loan money. So fiscal policy and monetary policy. Monetary policy, the management of money supply and interest rates, is conducted by the Federal Reserve System. Fiscal policy is our government spending and taxation. So in the federal government, we can have a budget deficit or a surplus. If we have a budget deficit, that must be financed by borrowing. States are not allowed to have budget deficits. So if a state discovers that they're going to have a budget shortfall, they either have to cut their funding or find some other way to cover it. Only the federal government is currently allowed to go into a true budget deficit financed by borrowing. This graph shows the government budget and surplus or deficit as a percentage of our gross domestic product from 1950 to 2016. As you can see, having a budget deficit is more common than having a budget surplus. The last time we had a large budget surplus here in the United States was during Bill Clinton's presidency. So Bill Clinton left his presidency with a surplus and we've had a deficit since then. The foreign exchange market. So foreign exchange market are where we convert one currency to another. And the foreign exchange rate is the price of one currency in terms of another currency. The exchange market determines the amount of the foreign exchange rate. Now, there are other things that influence the amount of the foreign exchange rate. So if you might have heard that the dollar is strong, that the US dollar becomes strong compared to other types of foreign currency, depending on our economic situation, which then goes back to financial policies, financial crises, and other things that affect the value of our current currency. So in class, we talked a little bit about euros and how the European Union was created to help reduce the amount of foreign exchange that was happening across European countries and how that has adapted. We'll talk about foreign exchange markets more in future chapters. The exchange rate of a dollar versus other currency from 1973 to 2017 is shown here. So it really depends on what currency you look at as compared to the dollar. So right now, the pound is more than a single dollar, but the Canadian dollar is less than a single dollar. So you can look online and see what current exchange rates are for items. When we go back to financial innovations, we can talk about blockchain. And we can talk about one of the hopes, the potentials of blockchain is to completely eliminate the need for exchange rates. That's one of the promises of cryptocurrency and blockchain. As I said, we'll talk about cryptocurrency more next week. The international financial system is the last thing that chapter 1 talks about. So financial markets are increasingly integrated. We know that we're in a global marketplace and a global business. The international financial system has impact on our domestic economies, and our domestic economies have impact on the international financial system. As I said, our exchange rate policy affects our monetary policy and vice versa. Our monetary policy decisions determine how strong our dollar is, which determines the exchange rate policy with other types of currency. How capital is controlled locally and nationally also impacts financial systems. So one of the things we're going to talk about as we move further than this chapter is what should the role of international financial institutions be in financial markets, and how fully integrated are we going to come? That is the end of chapter 1.